Here's exactly how to invest in stocks in 4 steps right now before I explain a single thing. 1. Open a brokerage account. It's free and takes about 10 minutes. 2. Move money into it from your bank. 3. Buy a low-cost index fund that owns the whole stock market in one purchase. 4. Repeat every month and leave it alone for years. That's it. That is genuinely how the majority of people who build wealth in stocks actually do it, not by picking the next hot company, not by watching charts all day. 4 boring steps repeated. The rest of this video makes each step concrete. What to click, how much to start with, what to actually buy, and the beginner mistakes that quietly cost people money. But you already have the map. Let's walk it. I'm Mr. Finance. I put real numbers on the money moves everyone talks about, but nobody walks through slowly. If that helps, subscribing takes 1 tap. Now, step 1. A brokerage account is just a special account that lets you buy and sell investments, the same way a bank account lets you hold cash. You can't buy stocks from a regular checking account. You need this middleman account, and opening one is free at every major provider. You've heard the names: Fidelity, Charles Schwab, Vanguard, and app-based ones like Robinhood. For a long-term beginner, the big established brokers are hard to beat. No account fees, huge selection of low-cost funds, and they've been around for decades. You do not need to agonize over this choice. Any of the major, reputable U.S. brokers will do the job. The worst broker you actually use beats the perfect one you keep researching for 6 months. Opening it works like any online sign-up. You'll give your name, address, social security number. That's normal and required by law for any U.S. investment account, and connect your bank. 10 minutes, and you have somewhere for your money to actually grow instead of sitting still. One important note for beginners: you'll often be asked whether you want a standard brokerage account or a retirement account, like a Roth IRA. If this money is for the long haul and you don't need it for years, a Roth IRA is usually the better home because the growth comes out tax-free later. If you want flexibility to withdraw anytime, a standard account works. Either way, the investing you do inside the account is identical. Don't let this choice stall you. Open one and move to step 2. Once the account is open, you move money in from your bank. A simple transfer, usually free, that lands in a day or 2. Now the question every beginner asks: how much do I need to start? The honest answer is far less than you think. You can start with $50. Most brokers now let you buy fractional shares, meaning you don't need the full price of a share. You buy $50 worth of whatever you want, even if one share costs $300. The idea that you need thousands of dollars to begin investing is the single biggest myth that keeps beginners on the sidelines for years. Here's what matters far more than your starting amount: whether you keep going. $50 once is a nice gesture. $50 every single month, automatically for 20 years, is real wealth. So the move in step 2 isn't just to transfer money once. It's to set up an automatic transfer that happens every payday without you thinking about it. Automation is what turns a good intention into an actual portfolio. And a hard rule before you invest a single dollar: only invest money you won't need for at least 5 years. The stock market goes up over long stretches, but it can drop sharply in any given year. Money you need for rent next month or an emergency next quarter has no business in stocks. Keep an emergency fund in cash first. Invest the money you can genuinely leave alone. That's the honesty anchor of step 2. Investing is for long money, not for money you'll panic over. This is the step beginners fear most because they think investing means picking the right company. It doesn't have to, and for most people, it shouldn't. When you buy a single stock, you're betting on one company. If it does well, great. If it stumbles, you lose. Picking individual winners consistently is extraordinarily hard. Professional fund managers with teams and tools mostly fail to beat the market average over time. If the pros struggle, a beginner picking stocks on a lunch break is playing a losing game. So here's what most wealthy, sensible long-term investors actually buy: a low-cost index fund. One single purchase that buys you a tiny slice of hundreds or thousands of companies at once. Instead of betting on one horse, you own the entire race. When you buy a total U.S. stock market index fund or an S&P 500 index fund, you own a piece of nearly every major American company in one shot. Why is this so powerful? Because you no longer need any single company to survive. Some will fail, and they get quietly replaced by rising ones automatically inside the fund. You're not betting on a company, you're betting that the overall US economy keeps growing over decades, which it has done through every crash, war, and recession in its history. That's a far safer bet than any one business. The two words to look for when choosing one: low cost. Index funds charge a tiny annual fee called an expense ratio. You want that number very small, 0.1% or so, not 1 or 2%. A cheap, broad index fund is, for the overwhelming majority of beginners, the single best thing you can buy. It's boring. Boring is exactly why it works. If you want to eventually buy a few individual stocks for fun once you understand more, fine, with money you can afford to lose. But the core of your investing, the part that builds real wealth, should be broad index funds bought consistently. That's step 3. The final step is the one that actually creates the wealth, and it's the one people get wrong. Repeat, and then do nothing. Investing consistently every month, the same amount, regardless of whether the market is up or down, is a strategy so effective it has a name: dollar cost averaging. When the market is high, your fixed amount buys a little less. When it's low, that same amount buys more, on sale. Over years, you automatically buy more when it's cheap and less when it's expensive, without ever having to guess the timing. You cannot time the market reliably. Automation quietly does something better than timing. It removes the need to. And then the hardest part: leaving it alone. When the market drops, and it will, sometimes scarily, the instinct is to sell before it gets worse. This instinct is what destroys beginner returns. The people who sell in a crash lock in their losses. The people who keep buying through it and wait historically recover, and then some. A crash, if you're still adding money and still years from needing it, is not a disaster. It's a discount on shares you were going to buy anyway. So step 4 is genuinely about doing less, not more. Check it rarely. Don't sell in fear. Don't chase whatever's hot on social media. Keep buying your boring index fund every month. Ignore the noise and let time and compounding do the heavy lifting. A beginner who invests $200 a month into an index fund and simply doesn't touch it for 30 years, at an average 8% return, ends up with roughly $300,000, having personally put in only $72,000. The rest is compounding, doing the work while they did nothing. That's the whole secret. Not activity. Patience. The person who did nothing beat the person who did everything. Because in investing, most of the doing is just fear and impatience, wearing the costume of action. Learn to sit still, and you've learned the hardest and most valuable skill in the entire game. Before the mistakes, let me answer the 6 questions that show up the moment someone finishes step 4, quickly and honestly. Which broker should I actually pick? Any major, established U.S. broker. Fidelity, Schwab, and Vanguard are all excellent, low-cost, and beginner-friendly. Pick one, open it, move on. The choice matters far less than starting. You can always transfer later, and almost nobody ever regrets which big broker they chose. Should I buy individual stocks? You can, but keep it small and separate. A common, sensible rule is to put 90% or more of your investing into boring index funds. And if you really want the thrill of picking companies, use a small, fun money slice you could afford to lose entirely. That way a bad pick can't derail your actual future. The core stays boring, the experiment stays small. What about crypto? Same rule, only more so. If you want exposure, treat it as a tiny, high-risk slice of fun money. Never your foundation, never money you need. Volatile bets belong at the edges of a portfolio, not at its center. When do I sell? For long-term investing, the honest answer is mostly you don't. Not for decades. You sell when you actually need the money for its purpose, like retirement, or to rebalance occasionally. You do not sell because the market dropped, because a headline scared you, or because it went up and you feel clever. The plan is to hold. Selling should be rare and boring. What about taxes? Inside a retirement account like a Roth IRA, growth is tax-free. That's why it's such a good first home for long money. In a regular brokerage account, you only owe tax when you sell for a gain or receive dividends, and long-term gains are taxed at lower rates than your paycheck. Translation: holding for years isn't just calmer, it's also more tax efficient. The lazy approach is rewarded twice. Is now a bad time to start? There is almost never an obviously good or bad time, and trying to guess is the trap. Markets are near highs more often than not because they rise over the long run, so it feels high, describes most of history. The person who waited for the perfect entry usually just missed years of growth. Start now, buy monthly, and let dollar cost averaging handle the timing you can't. Let me save you the common beginner mistakes, because avoiding them is worth more than any clever pick. Waiting for the perfect moment to start. There isn't one. The best time was years ago. The second best is your next paycheck. Time in the market beats timing the market. Every study, every time. Chasing hot stocks and crypto tips from social media, that's gambling wearing an investing costume. Keep your core boring. Selling when the market drops, the single most expensive beginner reflex. If anything, a drop is when your monthly buy works hardest. Buying high-fee funds, always check that expense ratio. A 1% fee can quietly eat a quarter of your lifetime returns. And checking your account every day, it only makes you anxious and tempts you to tinker. Set it up, automate it, and check it a few times a year. The less you touch it, the better it tends to do. That's not a joke. It's one of the most consistent findings in all of investing. One more, and it's the quietest killer. Comparing yourself to someone online who claims they doubled their money in a month. For every person posting a huge win, there are dozens who quietly lost and said nothing. Those posts are designed to make your boring, winning strategy feel too slow, right up until they blow up and your index fund is still standing. Envy is expensive. Run your own race at your own pace and let the boring plan compound while the loud money burns out. So, how to invest in stocks? Complete. Open a free brokerage account. Set up an automatic monthly transfer of whatever you can afford, even $50. Buy a low-cost, broad index fund that owns the whole market. Repeat every month, ignore the noise, and leave it alone for years. That's not a simplified version for beginners. That's what a huge share of genuinely wealthy long-term investors actually do. The strategy that works is almost boringly simple. The hard part was never the knowledge, it's the patience. And now you have the knowledge. 4 steps. Account, money in, buy the whole market, repeat. You can complete the first one today in about 10 minutes and start the second one with less than the cost of dinner. Nothing here required being rich, being an expert, or predicting anything. I won't pretend the market only goes up or that you'll never see a scary red day. You will. What I'll promise you is that the boring, consistent, low-cost approach has quietly outperformed almost everything clever over long stretches of history, and it's available to you on your very next payday. I'm Mr. Finance. Subscribe if you want more of this. Plain steps, real numbers, no hype. And tell me in the comments, are you about to open your first brokerage account after this? And what's the one thing that's been holding you back until now? I read every one.